Mike Muller, head of Vitol Asia. Mike, your thoughts and expectations, what OPEC might need to be considering if they want to see a kind of an average that we've seen in the first half of the year, $83, $84 Brent, continue through to the end of the year. What do they need to be thinking about in order to sort of achieve that sort of level of supply-demand balance in the market?
Demand, in one word. So the conventional wisdom for the past few months has been that year-on-year demand is up sufficiently so that OPEC plus the 22 countries may be able to allow themselves to put some volume back in the market without destabilizing a price in the 80s. Now, that's not been a phenomenon right now, and I'll come on to spot markets in a short while, but there's always been a consensus that in the peak demand period in the Northern Hemisphere, in the European and North American summer, there would be sufficient demand and therefore sufficient pull on inventories to allow a scenario where people see a slight tightening of balances, and that would provide that sort of prospect. Now, what we're actually seeing on demand is extremely high levels of oil product inventory on the water, which have been drawing down, a perception of high inventories in important markets like China, and I guess in most people's minds, a slightly downward revision in year-on-year demand estimates from admittedly very high levels to start with, which should have underpinned that first scenario I painted where the world was likely to go into a stock draw. So one felt that there should be space for there to be extra volume to come to the market, but I think the consensus in the market remains that we continue to roll over. However, we'll see in just under 5 hours' time in Vienna in Riyadh, less than that, then what actually transpires. But the critical thing was that OPEC Plus had commissioned 3 consulting firms, Rystad, IHS, and Woodmac, to come up with a verifiable set of production capabilities for the 22 countries, of which discussions will then be based. There was talk that I've seen online that there was a request for a draft, an early version of that report, in order to better inform today's meeting. I'm not sure if that's going to result in any new signaling, but one would suspect that this report will tell us what we already know, which is that many OPEC nations, African nations, for example, don't have the capacity to produce at their baseline, but others that have heavily invested of late, such as the UAE, will have continued space, and therefore there has to be a discussion around how those extra capacities translate into any new numbers. I'm not sure all that's going to transpire today. I think the market is expecting there to be very little by way of news and a rollover.
Mike, I mean, thinking about the market outlook, what would be I mean, obviously we know that OPEC Plus has to get to a restructuring of the baseline quotas by the end of the year, because that's when the agreement expires. Is there anything, or what would you think would be propelling dealing with it now, or doing an agreement that reaches into 2025, as is some of the reporting indicating? Your thoughts on the markets, what sort of signals you would take from that? Or is the market looking for that far out commitment already? Your thoughts on the timing, what it needs now rather than moving it to 25?
I don't see any particular trigger why there should be any added urgency, other than the fact that we're getting towards mid-year and people are beginning to ask questions about balance of year and looking beyond the peak summer demand period already. And I guess there's plenty of talk, and the talk has been fueled by some rather high-profile publications by various consulting firms. I mean, I'll remind everyone, OPEC see peak oil around 2040 plus at 114 million barrels a day, if I'm not mistaken. Goldman Sachs, who have been closely associated with the concept of peak oil in their latest report, revised upwards their demand for oil in 2030 from 106 to 108.5 million barrels a day, and projected their peak oil in 2034, which is a little beyond where most people have it, and they're peaking at 110 million barrels a day and plateauing there. JP Morgan then came up with a forecast that was also somewhat more bullish for the natural gas complex, and has prices staying in the 80s this year and tailing off into the 70s next year. Put alongside that a report that we need to give a little bit more credence to, I think, a Sinopec, so the biggest refiner in China, if not in the world, who, for domestic forecasting purposes, put out a peak oil demand year of 2027, just 2 years away. So on the one hand, you've got for China only, yes, but they don't see peak gas until 2040, incidentally, and peak coal this year. So, I mean, China forecasting and baking in a very advanced pace of electrification and renewables, but the Western or the Wall Street banks and consulting firms are all looking at a slowing pace, somewhat dissipating the forecasts of electric vehicle penetration, but also electrification of industries. So those divergences are somewhat polarizing opinion, but also stimulating debate as to where we stand. I promised to talk about the spot markets a little bit. I mean, what we're seeing in crude is a market that's amply supplied in the Atlantic Basin, as you would glance at a screen, not just looking at $81 something Brent, but looking at the structure of the market, which has lost a lot of the backwardation that it used to have. Now, on a forward basis, there's still plenty of backwardation, which is a structure that OPEC Plus tend to like the look of. But in the prompt, we have to worry about surpluses, which may be temporary or maybe less so. So as one bellwether, you look at how much Atlantic Basin oil, US exports and West African oil move to Asia. And that pull from Asia has been somewhat slower. And the big question on people's minds now is there going to be some catching up or not?
Mike, just quickly to follow up, sorry, Christopher, I just want to get Mike's view on why the oil price has dropped from the 90s, over the last 6 weeks, 7 weeks, or 2 months now since above 94. I mean, OPEC Plus be trying to figure out why that drop has come off so quickly over 6, 8 weeks, and will it stop or does it continue to fall? Is this a hot knife through butter? What are your thoughts on the why of that drop off and as it found its finish now?
I'm sure Christopher's equally qualified on this one, but I'll just say two things. When we went into the 90s, which is some time ago, there was a lot more geopolitical fizz in the market. There were a lot more concerns around the Israel-Hamas conflict in Gaza and whether that might have further ramifications. And the only real factor that has resulted from that, people are assuming that there won't be a proliferation of conflict beyond that particular area, has been the disruption to supplies caused by the Houthis at the Bab el-Mandeb, or the Straits of Aden. And therefore, this massive stock build on the water as ships go the long way around the bottom of Africa. So that's the reason we're from 90s to 80s. And as for whether we're in the low 80s, the mid 80s, or thereabouts, I don't think these price moves have been particularly profound. But yes, as we commented 3-4 weeks ago on this call, there have been some downward revisions in year-on-year demand, but from a very, very high base. I mean, we had started out, and we were just a few months ago calling 2024, I think, one of the top 4 highest year-on-year demand growth for oil ever seen. And we still have ahead of us driving season, a US driving season that's forecast to look pretty good, and probably the highest ever use of jet fuel the world's ever seen as we enter into Northern Hemisphere holiday season.
We've seen reports over the end of last week that Asia's imports of crude oil rose to the highest in 12 months in May, with reaching nearly 28 million barrels, driven more by an increase in India than China per se. But your thoughts as a whole, Asia's demand being a supporting pillar that could even grow further in the second half of the year if China starts to come back stronger. The outlook for the second half from an Asian demand point of view, and what OPEC Plus can think about that.
Yes, very topical question. I think we have a bunch of phenomena here, but the May data you're referring to is of no interest to traders anymore because we're trading July, August already. And the situation is pretty much as outlined for July and August. We have adequate stocks on the water of refined products, and we have slightly, I'll emphasize slightly, less pull on Atlantic Basin imports from Asia, maybe as a consequence of a little bit of over-purchasing that you referred to there in May. That said, the outlook in economies like India are and continue to be robust. I mean, you will have seen not just the elections, but the record weather temperatures. These in advanced Asian nations tend to lead to increased demands in air conditioning usage and therefore place extreme strain on the power grid, sometimes necessitating uses of energies other than those obvious ones, right? So Japan will go from burning LNG to maybe having to burn fuel. in order to make up local shortfalls. However, the heat is in India, of course, and there it could have different consequences. It could affect crops and harvests and mean less diesel gets consumed by tractors if the fields aren't fertile. So there are many possible pathways this can take. But I think on the whole, the outlook for gas feels very much buoyed by these heat events. But if you want to look any further than what's happening on oil products in Asia, you look at refining margins and look in particular at gasoline cracks. And these are trading at multi-year lows. If you strip out the COVID period of 2020, 2021, Singapore gasoline has been generally trading at double-digit per barrel premium to Brent, what we call the crack, a big component of the margin, and that's sunk to negligible single digits. So we're at all-time lows on that particular front, and that doesn't bode particularly well, even though there was a view that gasoline demand growth is particularly robust in places like China. And then you look at what that means for refinery behavior, and refiners, of course, will be very quick to advertise that they might consider cutting runs in order to soften the view of the crude oil sellers that they're facing. It is that time of month when we are at the beginning of the month and programs get nominated and people call for how much OPEC oil they wish to see in their buying programs. So you generally hear a little bit more noise at this time of month from those refiners that have marginal capacity as to whether they'll be running that capacity or not. And that's the sentiment right now, which is a little softer.
Mike, just to follow up on that, we have a question in the chat room. We're looking for comment on the Middle East is putting 1.5 million barrels a day of products more to the market this year, and that is indirect way to crude exports. Where do you see those two things intersecting?
Well, demand growth is up globally by at least that much. So the market needs that capacity. And there aren't many other places in the world outside China where refinery capacity has been added. If anything, I think there's been much made of the fact that the global refining system is old and more susceptible to disruptions. So I don't think that in itself poses a problem. It's bullish shipping because, of course, the extra product made in the Middle East has to find its way further afield. And you'll see a whole bunch of references to clean freight rates being high, whereas dirty freight rates are less so. And ships therefore being incentivized to clean up in order to perform those voyages that need to take the clean refined products from the Middle East to largely the Atlantic Basin.
Mike, I wanted to give you the last word on China. We can never let you go without giving a sense of China. And I referenced the IMF revision upwards in their GDP forecast for China this year. Last week, they rose their forecast by 0.4%. How should the OPEC Plus meeting today look to China for the second half of the year and its incremental demand growth? Should they read much into the IMF numbers? Does China look like it's finally getting its feet again? Your thoughts on the second half of the year for China oil demand?
It's terribly difficult. I always chime in on the more bullish, constructive side when it comes to China, and that's not just because I'm sitting in Asia. I wouldn't read too much into that 0.4%. I think we need to look at the bare facts across all commodities, industrial commodities, and China might have positive growth indicators now in its manufacturing sector for several months already. But I think we need to continue trading cautiously when trying to make predictions for energy demand growth. As I said a while back, I think demand for China importing gas looks a little bit more healthy. But on the oil side, they are amongst those refiners talking about potentially conducting run cuts because onshore inventories are adequate. But if I may, and you're the journalist, you might love this, Sean, here, literally 80 meters that way in the Shangri-La Hotel ballroom, we had the Chinese defense minister this morning make some comments that were quite firm relating to Taiwan and the new government there, which he referred to as separatist. And I mean, go look it up on the headlines, but these comments may be perceived by the world as slightly more hawkish than expected. And there have been various retorts and comments around South China Sea as well, with Ferdinand Marcos here, future president of Indonesia, and Zelensky just flew in also. So he's 2 kilometers that way in the presidential palace. So I'm in one of the best protected places in the world right now. But there are several headlines emanating from this 21st Global Defense Ministers Conference, where just about all of them are here, which are worthy of a glance over the weekend.